Well, we hear a lot about the high cost of living taking a toll on Canadians, and a new poll finds that many grandparents are finding themselves financially supporting their adult children along with their grandchildren. This is according to an RBC poll that also shows the majority of grandparents are even sacrificing their own savings to provide some assistance financially to their family. Philip Petursson is Chief Investment Strategist at IG Wealth Management, and he's back with us now. What do you make of a headline like this? The fact that people, not only grandparents, they like to give the envelope with a little cash to the grandparents, but to the grandchildren. But here's a story of supporting grandchildren and their adult children because of the financial strains here in Canada right now.
Yeah, it's something that it's not necessarily new. We've heard about multi-generational support for years. Parents giving a down payment for a house to their kids when after they get married. But you're hearing more and more about it. So the first thing that comes to mind is I think everyone needs to engage with a financial planner because some of the struggles that they're faced with might be alleviated by just better planning.
And I guess the consideration on that is costs change, life changes, the financial realities can change, and you have to kind of put all those different entries into the machine to figure out what that all means.
Exactly. I mean, there are things that you can use to lower your taxes, to increase your savings, to increase your tax-sheltered savings that could alleviate some of these financial stresses along the way. But that said, if we are thinking about one generation, the older generation, helping the younger generations, this is the inheritance that we've been talking about, the $3 trillion in this country that it will be passed on from one generation to the next. It's just not happening upon death, it's happening before then. If it's providing stress to the older generation, well, that's a challenge, that's a problem, and I think that should be avoided. But passing on an early inheritance isn't necessarily a bad thing.
Well, obviously, there's a lot of considerations for older Canadians on that front when you're thinking about passing wealth from one generation to the next. I think a lot of our audience are people who are actively in the market, and they are managing their own retirement savings as well. And all of a sudden, I guess, if there's these other considerations, not to suggest that younger Canadians are less skilled at generating wealth. It's just that right now everybody's dealing with these higher costs. You spend a huge part of your paycheck at the grocery store as well. But I think that, outside of financial planning for everybody in the family, for those who are actively managing a retirement savings right now, and then they're dealing with some of these family needs for higher financial resources in the short term. How do you balance that? You want to stay on course with your own retirement plan as an older Canadian, and then you've got these other costs that you're having to deal with through family.
Well, I think that's the most important thing, the first part there, which is you need to maintain your own income as you move forward. I mean, you don't want to create a burden in the future for the younger generation by alleviating some stress today. I mean, that might not be the optimal solution. So it's maintain your course, maintain your path forward, and then help where you can. I think the interesting nuance that we're seeing today versus, say, 10 years ago is that the older generation, the retired generation, is benefiting from higher interest rates as they are primarily savers, whereas the younger generation is facing the detriment of higher interest rates. So there might be a little bit of flexibility for that older generation that is generating higher incomes out of bonds to support the younger.
They might even have the benefit, not true in all cases, but maybe they bought a home a very long time ago before homes ended up costing what they cost today. But I'm glad you talked about sort of, I think it is generally assumed that they are savers, that they are looking for lower risk investments. Maybe it's a bigger bond portfolio. And yet we've been talking forever in the stock market about how technology stocks, right, over the last decade, even if you're already in retirement, what a bigger benefit to your portfolio you would have seen from taking on a little bit more risk. Mm-hmm. Do we need to have a fresh conversation around what it means to take risk? At what point in your investing career taking risk needs to be ratcheted down if some of the performance in the market has just been so skewed, exponentially so, with certain assets?
Yeah, and that is a great question, and we've done studies on this in the past where we look at what is the optimal asset allocation in retirement versus pre-retirement. And all the work that we've done leads us to the conclusion that you need to maintain that level of risk in retirement. Our retirements are longer than what they were the prior generation. Prior generation had a much shorter lifespan than we do. You can expect to retire, if you retire at 65, you can expect to have 30 years in retirement, perhaps more than that. So your income needs or your growth needs are greater. And therefore, you should have more exposure to equities, or you shouldn't reduce as aggressively as perhaps prior generations have your exposure to equities in retirement, because you need that growth to continue.
I guess my final question, I would assume at the end of the day, if people are having to deal with family needs on the capital front, housing remains this massive question mark for the Canadian economy. And I do wonder what you think is going to happen with housing prices over the long term.
It's a great question. When we look back at prior periods, let's say we're in a downturn right now. We saw today housing prices were down in Canada again. If you go back to the late 80s to the early 90s, in Toronto and GTA, we saw housing prices fall by 50% from 89 to 92, and then take about 10 years to recover to the prior high. It's not unusual to expect, or we shouldn't just discount the similarities today versus then, that interest rates have gone up, they're putting the strain on some consumers, and housing prices are coming down as a result of that. I think longer term, it always comes back to buy what you can afford. And I think if people continue to maintain that kind of in-house ecosystem, if you will, buy what you can afford, I think they're better off over the long term.
And I guess